Welcome to this Chapter 14 tutorial on corporate surplus distributions. Moving on to the next slide, let's talk about what we're going to be focusing on today. Now, when we talk about distribution of corporate surplus, we're basically referring to corporate surplus as what accountants refer to as retained earnings. So we're going to distribute some of our corporate surplus or retained earnings. Now, most common is the payment of cash dividends. When individual shareholders receive a cash dividend, that individual shareholder must gross up the dividend and include the grossed up amount or the taxable dividend in their taxable income, and they will receive a dividend tax credit. Now remember, there's two types of dividends that individuals can receive, non-eligible and also eligible. What we're going to look at in this tutorial is also there's a third type. There's also what we refer to as capital dividends under Income Tax Act 83(2). Now, capital dividends are received tax-free by the individual shareholder. We're also going to talk about stock dividends. Those could be an alternative to a corporation paying cash dividends. And then we're going to look at what we call deemed dividends under these sections of the Income Tax Act, 84.1, 84.2, 84.3, and 84.4 and 4.1. So moving on to the next slide, let's look at the first topic, which is capital dividends. Now, a private company tracks their CDA, capital dividend account, and the balance in their CDA means that that private corporation, when they pay a dividend, they can designate up to the balance in their CDA account as a capital dividend. So what's the benefit of that? Well, the benefit is that the individual shareholder on the receipt of a capital dividend will not be taxed. Now, the rationale is to keep certain tax-free amounts tax-free even though they're distributed to the shareholders. So let me give you a simple example. Let's say we have this private corporation, ABC Corp, and they sell land and realize a $100,000 capital gain. Now, we learned that capital gains are only 50% taxable. So only $50,000 will be subject to tax. The other $50,000 is tax-free. Now, ABC Corp is a private corporation, so they can add $50,000, that tax-free amount of the capital gain, to their CDA, to their capital dividend account. And let's say later on, ABC is going to pay a $10,000 dividend to their shareholders, and they designate that $10,000 as coming out of their CDA, and therefore that $10,000 will be designated as a capital dividend. Now, if they do that, their CDA balance will go from $50,000 to $40,000 because they've used up the $10,000, and the individual shareholder that receives the $10,000 capital dividend will not be taxed on that. So that's sort of a simple example of a capital dividend. Now, in your textbook, it does go through the different components of the CDA, the capital dividend account. So make sure you review all the things that will impact a company's CDA balance. Let's go on to an example on the next slide here. Pause the video, read through this question, and then once you've read through the question, try to calculate the CDA balance at the end of the year for this company, App Inc., and also explain what the tax consequences are to Gladys. So pause the video now and resume the video when you're ready to review the solution. So let's go through the solution together. Now, the first thing we're going to do is calculate the CDA balance for App Inc. We start off with their opening balance at the beginning of the year, which is $300,000. Now we know to that we're going to add and adjust for non-tax items, and one of those non-taxed items is the non-tax portion of the capital gain. So the capital gain that the company realized was $200,000. So $100,000 will be taxed, and $100,000 will not be subject to tax. So the non-tax portion we add to the CDA balance. Now with capital losses, the same thing. The amount that's not deductible, which is $120,000 times 50%. So that $60,000 non-deductible capital loss will be deducted from the company's CDA balance. And then also in addition to that, if App Inc. receives capital dividends, they're going to add that amount to their CDA account because once again, we want to keep all those tax-free amounts tax-free. Even if they receive a tax-free amount from their investments, they're going to add that to their CDA balance. And so when App Inc. distributes that to their shareholders, it will remain tax-free. Now, the other adjustment we have to make is any dividends that App Inc. designates as a capital dividend, that's going to reduce their CDA balance. And so in the current year, they paid $64,000 capital dividend. So that's going to reduce their CDA balance. And so at the end of the year, the company's CDA balance will be $346,000. Now, in terms of the tax consequences to Gladys, Gladys is going to get this capital dividend and it's going to be tax-free. So there's going to be no tax that she has to pay. Now, capital dividends are not grossed up. There's no dividend tax credit because there's no tax that has to be paid on it. And also a final point, capital dividends cannot be designated as eligible or non-eligible. Moving on to the next slide, let's talk about stock dividends. Have a read through this example for Weave Corp. And once you've read through the question, then resume the video and we'll work through the solution together. So pause the video now. Let's take a look at the solution together. Now, the question asks us to calculate the new PUC per share and also to explain the tax consequences to Mrs. Braid. Now, just a bit of a refresher from the earlier video with respect to PUC. PUC is paid up capital. Now, the PUC per share is going to be the same. So if a company has Class A common shares, there's going to be one PUC per share for all the shareholders. The individual shareholders may have bought those Class A common shares for different prices. That's going to be their ACB. The ACB, the adjusted cost base, is going to be different for every shareholder because shareholders will buy the shares at different prices. However, for PUC, paid up capital, there's only one average PUC per share for all the shareholders. So let's go through the tax consequences of this situation. Now, this is a stock dividend. Now, if you remember from stock dividends from your accounting courses, whenever a company declares a stock dividend, it's going to be declared as a certain percentage. So Weave Corporation, in the middle paragraph here, declares a 5% stock dividend. So what does that 5% mean? That 5% means that they're going to issue 5% additional shares in terms of the numbers. So if they currently have 2 million shares times 5%, that means there's going to be a new 100,000 shares issued as a result of this stock dividend. So that's the first thing. Figure out the number of new shares. We take the number of current outstanding shares, 2 million, times the 5%. That means there's going to be 100,000 new shares being issued as a result of the stock dividend. Then we got to figure out what the value of the stock dividend is, and we multiply that by the trading price, which is $2.50. And so the value of the stock dividend is going to be $250,000. Now that's going to increase the PUC for these shares. So the updated PUC is going to be the original PUC, the 3.5 million, plus this new addition of 250,000. And so the updated PUC is going to be 3.75 million. Now, remember I said that there's only one PUC per share. So when we talk about the average PUC per share, it's calculated for the entire class of shares altogether. So to figure out the PUC per share, we're going to take the 3.75 million divided by the number of shares outstanding. So remember, initially there were 2 million shares outstanding, but because of the stock dividend, there was an increase of 100,000 shares. So we take the 3.75 million divided by the 2.1 million shares, and we're going to get an average PUC per share of $1.786. That's rounded to 3 decimal places. So that's going to be the first part of the requirement. We've calculated the new PUC per share. Now we're going to figure out what are the tax consequences to Mrs. Braid. So she's going to receive the stock dividend. Now we got to figure out, well, how much of the stock dividend is she going to receive? Now she owns 10,000 shares. And this is a 5% stock dividend. So that means she's going to get 500 new shares as a result of the stock dividend. That's the first step. Then what is the value of the stock dividend? Well, we take the 500 shares plus the trading price of 250. So the value of the stock dividend is going to be 1,250. Now, whenever a company issues a dividend, they have to indicate whether it's a non-eligible or eligible dividend. Now, in this example, Weave Corp is going to declare this as a non-eligible dividend. And so Mrs. Braid then will include the 1,250 as a non-eligible dividend. She has to gross it up. She's going to add it to her net income for tax purposes, and also she'll get a dividend tax credit. So that's going to be the tax consequences to Mrs. Braid. Now her ACB will also increase as well, because now she has an additional 500 shares. So her original ACB on the first 10,000 was 22,500. Now she's going to add the 1,250 to her ACB because she was taxed on that, right? So because she was taxed on the 1,250, she's going to add that to the cost base of her shares. So the new ACB will be 23,750, and that's going to be for her now 10,500 shares in Weave Corporation. So that's an example of stock dividends. Moving on to the next slide, we're now going to move into what we refer to as deemed dividend. And the first one we're going to look at is under section 84.1. Now 84.1 deals with a situation where there's an increase in PUC. There's an increase in paid up capital, and the corresponding increase to net assets is smaller. So let me give you an example. So let's say there is this corporation that has $10,000 in debt, and the corporation goes to the debt holder and says, if you exchange your $10,000 in debt and we give you $11,000 worth of shares, will you be okay with that? And so they say, yes, okay, I'm currently a debt holder. I hold a debt in a company for $10,000. I'm going to give up the debt in exchange for $11,000 worth of shares. And the reason why the shares might be worth more than the debt is because once the debt is exchanged, they're going to lose all those future interest payments. So that could be a reason why the value of the shares is higher than the debt that's being exchanged. So think about the accounting equation. Assets equals liabilities plus shareholders' equity. If we rearrange that, assets minus liabilities is your net assets. So assets minus liabilities is your net assets. That should equal to your shareholders' equity. So let's think about it in that concept. The net assets will increase by 10,000 because liabilities are going to be reduced by 10,000. So the net assets will increase by 10,000. However, that does not equal the increase in shareholders' equity. The shares will increase shareholders' equity by 11,000. So now we have this imbalance. The shareholders are getting $11,000 worth of shares, but they're only giving up $10,000 worth of liabilities. So the shareholders are ahead by $1,000. That's the amount of the deemed dividend. Now, another way of looking at this would be from an accounting perspective. Now, PUC and deemed dividend are strictly tax concepts. So I'm only sort of giving you another way of understanding about this deemed dividend, but once again, PUC and deemed dividends are purely tax concepts, and so there wouldn't be sort of this type of a journal entry with respect to PUC and deemed dividend. But think about what would be happening here. From the company's perspective, they're eliminating $10,000 worth of debt. So there would be a debit to the liabilities for $10,000, but they're issuing $11,000 worth of shares. So the credit would be to $11,000 of share capital. Now we have this imbalance, and we learned that in accounting that the total debits must equal the total credits. So we need a debit of $1,000. And so because we're interacting with the shareholders, we're giving them 11,000. So that extra 1,000 has to come out from probably retained earnings. And so when an amount is paid out of retained earnings, that is a dividend. So think about it in sort of the concepts of an accounting journal entry, even though PUC and deemed dividends are purely just tax concepts. Let's go on to the next slide and look at an example of 84.1. So have a read through this question. Try to figure out what the deemed dividend is. What's the difference between the increase in net assets versus the increase in PUC, or shareholders' equity? See if you can figure out what the deemed dividend is, and then we'll work through the remaining calculations and figure out what is the deemed dividend specifically to Kelsey. So pause the video now, and then once you've read through the question and done some calculations, then resume the video. So let's look at this question together. In this question, we're trying to figure out what is the deemed dividend. So a creditor is going to give up $400,000 worth of debt and take back 20,000 new common shares. And at this time, the shares are trading for $22.50. So the net assets will increase by $400,000. So the corporation's liabilities will decrease by $400,000. So therefore, their net assets will increase by $400,000. That does not equal the increase to shareholders' equity, because the shareholders' equity is going to increase by $450,000. There's going to be 20,000 new shares being issued at a value of $22.50. So shareholders' equity will increase by $450. And so the deemed dividend, the benefit to shareholders, is going to be $50,000. Now, yes, only the creditor is the one getting these new $20,000, or getting these new 20,000 shares. However, when there's a deemed dividend, it's going to impact all the shareholders. So even though Kelsey is not the one giving up the debt, Kelsey's going to have a deemed dividend as well, because once again, when we talk about deemed dividend and impacts to PUC, that's going to affect all the shareholders holding that class of shares. So now we're going to figure out what's going to be the impact to Kelsey. So the deemed dividend of $50,000 is going to be allocated to all the shareholders. So let's do some calculations. What is the number of shares that the company currently has issued? Well, they started off with 100,000, and as a result of this exchange of debt for shares, they've had to increase the shares by 20,000. So now there is 120,000 of shares in this class, and that includes the amount that Kelsey owns as well. So the deemed dividend per share is going to be 50,000 divided by 120,000. So every shareholder, not just the shares that the creditor now holds, but all the shareholders that own the 120,000 shares will now have to report a dividend of approximately 41 2/3 cents per share that they own. So because Kelsey owns 2,000 shares, her deemed dividend is going to be $833.33. So once again, Kelsey's going to have to include that as an actual dividend in her income for the year. And once again, depending on whether it's designated as eligible or non-eligible, she's going to have to gross it up, and she will get a dividend tax credit for that. Moving on to the next slide, let's look at deemed dividends under 84.2. Now, under 84.2, this is when there's a winding up of a corporation. So let's talk about what do we mean by winding up. Let's go through a simple example. A corporation is going to wind up. They're going to cease operations. So what are the steps that happen when a corporation decides it no longer wants to exist anymore? They want to stop all operations and basically wind up and take the corporation off it being a corporate entity. So what are the basic steps? The corporation is going to sell their assets. They're going to get cash for all their assets. They're going to pay off all their liabilities, including their income taxes, and then they're going to have just cash remaining. The remaining cash that they have will be distributed to all the shareholders in the redemption and cancellation of all those shares. And so when the cash is distributed to the shareholders in exchange for all their shares, there could be a deemed dividend and possibly a capital gain or capital loss as well. Now, in this chapter 14, we're just going to focus on the deemed dividend, capital gain, capital loss aspect. but the actual steps of a winding up will be discussed in detail in Chapter 17. So moving on to the next slide, let's go through this example together. So pause the video, read through this question, and then once you've done reading through the question, resume the video to walk through the deemed dividend calculation. So pause the video now. So let's go through this winding up together. Now, after everything has been done, Moby has $7.7 million in cash. And all of that cash is going to be distributed to the shareholders. And in this example, there's only one shareholder, Floyd. So Floyd is going to get $7.7 million on redemption of his shares. So that's going to be known as the proceeds of redemption. Now, once again, the amount that can be returned tax-free is the puck amount. So we take out the puck amount, and the difference is the deemed dividend. So Floyd will have a deemed dividend of $7.488 million. Now, because the company has a balance in their CDA, the capital dividend account, the company is going to designate $694,000 as a capital dividend. So on receipt of the capital dividend, Floyd will not have to pay tax on the $694,000. The difference, however, the $6,794,000 will now be a non-eligible dividend because once again, the company does not have any GRIP balance, so they cannot designate any dividends as eligible. So the total dividend again was $7.488 million. Of that, $694,000 will be designated as a capital dividend, and the remaining $6,794,000 will be a non-eligible dividend. And so once again, Floyd will have to gross that up, include that in income, and claim a dividend tax credit. Now, remember I said there were sort of two possibilities. There could be a deemed dividend and there could be a capital gain or capital loss. So that's the first step. There is a redemption of Floyd's shares. But in addition to that, there's also a disposition. So now we're going to figure out, is there going to be a capital gain or capital loss? We start off with the same $7.7 million. Now, in order to avoid any double taxation, the deemed dividend is going to be subtracted for this amount. Remember, the deemed dividend was $7.488 million. So the adjusted proceeds are now $212,000. From this amount, we're going to subtract Floyd's ACB, adjusted cost base, which was $1,194,000. And as a result, Floyd will also have a capital loss of $982,000. Now remember, capital loss is only 50% allowable, so his allowable capital loss will be $491,000. He can use that allowable capital loss against taxable capital gains in the current year, or it can be any unused amount will be a net capital loss carryover. So that's an example of a Section 84.2 wind up of a corporation and what the impact would be for the shareholders. Moving on to the next slide, we're going to look at 84.3. Now, the first paragraph here says that the rules for 84.3 are similar to our 84.2. However, there's no winding up. With an 84.3, there is going to be a redemption, acquisition, or cancellation of shares, but is not as a result of a wind up. So the rules are going to be similar, but there's no winding up. So have a read through this example here for Canna Corp. Once you've read through the example, then we'll walk through the calculations together. So pause the video now to read through this example. Okay, let's look at the calculations together. So Olivia has 20,000 shares, and the company is going to redeem those 20,000 shares. There's no winding up, so that's why we fall under 84.3. Now, how much is Olivia going to get on the redemption of her shares? Well, she has 20,000 shares. She's going to get $20 per share, so she's going to receive $400,000 as her proceeds of redemption. Now, when shares are redeemed, the amount that's going to be free of tax is the puck amount. Now, remember, there's only one puck for all shareholders. So the puck per share as given above, is $16 per share. So the amount that's going to be tax-free is going to be 20,000, Olivia's 20,000 shares, times the puck per share of $16, 320,000. That's going to be tax-free. So Olivia will have a deemed dividend of $80,000. Now, once again, that amount she has to include in her income. And because Canada Corp has no GRIP balance, this will be designated as a non-eligible dividend. She'll include that in income and get has to gross that up to include in her income, and then she'll get a dividend tax credit. So that's the first step. Now, similar to 84.2, the first step for 84.3 is the proceeds of redemption to figure out whether there's a deemed dividend. Then we got to look at the proceeds of disposition. She's also disposing of her shares. She's going to get $400,000, but to avoid double taxation, we're going to take out the deemed dividend amount, and so her adjusted proceeds are going to be $320,000. From that amount, we subtract her ACB. Now, she bought the 20,000 shares at $14 per share, so her adjusted cost base is going to be $280. So in addition to the deemed dividend, she's also going to have a capital gain. Once again, 50% of that will be taxable. So that's an example of an 84.3. Moving on to the next slide, let's look at the last topic, which is an 84.4.1. Now, both of these sections refer to what's called liquidating dividends, but the 84.4 applies to private corporations, and 84.4 is private, and 84.4.1 is applicable to public corporations. So these rules apply to what's commonly known as a liquidating dividend. And what happens is a company is going to sell or divest itself of maybe one of their divisions. And when they sell off that division, they decide not to reinvest the proceeds, and they're going to give those proceeds to the shareholders. So they're going to distribute the capital from the selling off of one of their divisions to their shareholders. And in doing so, it's not going to involve any redemption or cancellation of shares. If it did involve redemption or calculation of shares, then the transaction would fall under 84.3. Remember, 84.3 was redemption, acquisition, or cancellation of shares. So if there was a sale of a division and the company used some of those proceeds to give to their shareholders, but it involved a redemption or calculation of shares, we would use 84.3. But in an 84.4, they're giving those proceeds to the shareholders with no adjustment to the shares. So that's the difference between the 84.3. It does involve redemption or cancellation of shares. Now, when there is what we call a liquidating dividend, there's usually going to be a reduction of puck as well. And so a company making a liquidating dividend can say, well, I'm going to also, as a corporation, reduce some of the puck. And that way, if you think about the puck, if puck is being reduced, that's going to give some of that liquidating dividend as a tax-free dividend to the recipient shareholders. And we'll go through an example on the next slide. Now, any amount that is tax-free will not only reduce the puck of the shares, but it's also going to reduce the ACB of the shares. And then the final point on this slide is that, well, as I said earlier, the 84.4 rules apply to non-public corporations, and the 84.4.1 applies to public corporations. So let's look at an 84.4 on the next slide as applicable to non-public corporations. So J owns all the shares of K9, and K9 is a CCPC. Have a read through this question, and then we'll walk through the tax consequences of this liquidating dividend together. So pause video now, and then resume the video once you've read through this example. So let's go through the tax consequences of this liquidating dividend together. Now, whenever there's a liquidating dividend and it's accompanied by a puck reduction, in this example, the puck reduction is 108,500, we have to update the puck balance and also the ACB balance. So let's do that first. Now, originally the puck had a balance of 195,000. As a result of this liquidating dividend, K9 decides to reduce the puck by 108,500. What that means is that because they're going to reduce the puck is going to be lower. So as a result of that, this updated puck of 86,500, if in the future K9 decides to redeem shares, only 86,500 will now be tax-free to the recipient shareholder. So this reduction will give J some tax-free amount on the receipt of the liquidating dividend. We'll get to that later on, but we have to update the puck balance with this puck reduction. Now, in addition to that, J's adjusted cost base will also be reduced as well. So J's adjusted cost base initially was 272,500. That's going to be reduced by the puck reduction. And so J's updated ACB is going to be 164,000. And once again, the reason for that is that some of this liquidating dividend that Jay is going to be receiving now is going to be tax-free. And so both the puck and ACB have to be reduced accordingly. Now, what are the tax consequences to Jay then? So Jay is going to receive this liquidating dividend of 149,500. Now, because it was accompanied by a puck reduction, that amount will reduce the amount that Jay is going to be taxed on. So his deemed dividend under 84.4 is going to be only 41,000. Now, once again, Jay is going to have to gross that up depending on whether it's an eligible or non-eligible dividend. We're not told in this example. And then he'll include that grossed up amount in his income, and he'll also get a dividend tax credit. So that's sort of a simple example of deemed dividend under 84.4. Now, moving on to our final slide, we said that 84.4 applies to non-public companies and 84.4.1 applies to public companies. So under 84.4.1, as applicable to public companies, if a liquidating dividend is made with a puck reduction and there's no redemption or cancellation of shares, it would fall under 84.4.1 if it was a public company. Now, under 84.4.1, the entire liquidating dividend is the deemed dividend. Even if there's a puck reduction, it does not reduce the amount of the deemed dividend to the shareholder. The amount of the liquidating dividend will equal the amount of the deemed dividend to the shareholder if the company is a public company. So let's look at that preceding example. K9 is now a public company. So if K9 in the preceding example was a public company, the entire 149,500 liquidating dividend would be a deemed dividend to the shareholder. That entire amount would be subject to tax. Now, because that entire amount was subject to tax, there's going to be no reduction to the adjusted cost base. And there is an exception to 84.4.1, and that exception says that if the transaction that resulted in this liquidating dividend was considered to be outside the normal course of the business of the corporation, then this would not apply. So that brings us to the end of this tutorial on distributions of corporate surplus. Good luck with your studies, and we will see you in the next video tutorial.